Ryan Irvine joins me again. Very pleased to have him with me from keystocks.com, Keystone Financial. Ryan, first of all, lots to talk about. I want to start with and I'll come back to this in a second, but this is a business where getting results counts. And of course, we've been working together for years, and Keystone, you and Aaron Dunn put out the World Outlook small cap portfolio with your team. And I just wanted to give a quick update that on average in this environment, you're up 25% basically, up 25%. So I want to start with a congratulations on that. It's not been an easy environment, but it goes choosing the right kind of stocks, looking at the right aspect of the variables involved, pays off.
Yeah, no, I thanks for having me on again, definitely, and I hope everybody's staying safe out there. It's great to talk with you, but we're very, very much heartened by the returns of that portfolio. There's 4 companies in there. All 4 of them are up. We had one of the companies, Viamed, do a 61% return since COVID. I think what is a teaching point from this portfolio, from those 4 companies, this small mini portfolio, is that there's a common theme to all these companies. And heading into the outlook in February, we saw the markets generally, the fundamental valuations, the ratios that we look on the broader market, the price to cash flow, the earnings multiples that we track on a daily basis, as historically high. So we wanted to buy companies with a distinct profile, and those would be companies with strong balance sheets and strong current cash flow. And all of these companies had net cash positions, so they had net of all the debt in the business. Some of them had no debt. They had a great cash position. So if there was some volatility going forward, these are businesses that could survive, then thrive, and we've seen them do just that through what has been really a unprecedented time of volatility to start this year.
But I'm really glad you started with that because, of course, you have to look for certain aspects, as I say, for certain variables. And what was so accurate about that approach is that we were in, as MoneyTalks have been chronicling since September, we are in a liquidity crisis. Cash flow would be king. And whether the rest of the world recognized that's certainly the Bank of Canada and the Central Federal Reserve have certainly validated our observation and our approach there. And that all comes back to cash flow. So just an example where understanding the environment and picking the right variables to focus on is what the key is. Let me come to come a little bit different here, because I've been chatting with lots of professionals in the business, and they're talking to me about cash. And they're saying, they've sort of lightened up right now. They're getting into a more defensive position. They're worried about maybe a downturn. At least they think that the downside is probably going to be more profound than the upside opportunities lost. So they're talking about cash. What's your take on cash during this kind of an environment?
Yeah, I mean, I think for us, when we look at cash, it's so twofold. You can look at cash in your portfolio, and I think we did a report in each area of our service in the midst of this crisis, saying it's good to have an above average level of cash in your portfolio, but also pay attention to the businesses that you own, and this is really key to us, and make sure the balance sheets in those businesses are sound. And if they earn cash, and they hold cash right now, net of their debt, those are the companies that can survive during a downturn. They're more resilient. You got to have a business that has cash and has resilient cash flow as well. But if they have that cash, what they can do is go out and make opportune purchases in a recessionary environment, in a crisis environment, and they can thrive coming out of that environment. So those are the companies, the businesses that we want to own right now. It's very simple. We want to keep it really simple. Are companies that have those fortress balance sheets, and that is what we are looking for right now. Because we've been through several crises, several crashes and recessions in the past, over the past 2 decades of our research, and the companies that have done the best coming out of these type of situations is the companies that had those fortress balance sheets, and those are the companies that we paid attention to. And we were doing that. We're not doing that in retrospect. We're doing that at the start of this year. We focus on that in our research all the time. But right now it's more acute, and we want to focus on the structure of the business. Is the balance sheet good? Is there a stockpile of cash? Is there resiliency in the cash flow? Can they handle that downturn? And when you have a downturn, when we saw that abrupt at one point, the TSX was down nearly 40%. When you saw that abrupt drop, it was good to know two things about the businesses. The structure, is there cash? Is it a good cash-producing business? But know the business as well. It's critical to know what that business does that you have in your portfolio. Can I give an example of that? I think that is an excellent example in a downturn. Now, Viamed is a company that we've recommended on this show for a couple of years now, and we recommend it as part of the portfolio. Now, there was certainly a ton of uncertainty, and there still is at the onset of COVID-19. There was indiscriminate selling. So a company like Viamed, what they do is they make medical devices. They employ one of the largest fleets in the U.S. of respiratory therapists. They treat patients with respiratory disease via non-invasive ventilators. Now, again, we're in the midst of a pandemic, which is created by a virus that causes respiratory disease. This is a very profitable business ahead of this, and it was trading at $7 roughly to start the crisis. At the peak of the selling, this company dropped below $4 for a point. Now, this was absolute panic selling. If you know the business that you own in your portfolio, you know it has no balance sheet concerns, it has cash on hand, provides an essential service, and is actually positioned, this company was actually positioned to assist the efforts to help the healthcare system fight COVID-19. You know not to sell then when everybody else is panicking just because you see price action movement in that stock. So if you panic at that time and sell because you don't understand the business, you miss out on the company. The company is now at new all-time highs. It's $11.50. It's up 60% since the crisis started. But if you didn't know and understand that business, both structurally and in just what the day-to-day activity of this business is, you may have panicked in that downturn and sold and crystallized losses where you could have had tremendous gains this year in that business. So it's really important to know the quality of the business in terms of the cash flow, the resiliency, what the balance sheet looks at, but also know what the business does, or at least employ somebody who can understand what the business does and whether it should be in your portfolio in any time in the market, particularly when a crisis comes and there is a lot of emotion in the market. You're able to sleep at night if you know you own a Viamed that is essential in that time, or if you own a Microsoft, which is great for the work from home environment or the cloud computing environment, or if you own like an Enghouse, which was in that portfolio. These are businesses I want to know because Enghouse, we know, just a year ago bought a business that is in the telemedicine sector. So critical in this type of environment to own those type of businesses. And then they have the fortress balance sheets too as well. So all of those things will help you sleep at night if you know about the stocks you own. And that is one thing you can control right now. You can't control the noise around the markets, but you can control the individual businesses that you put in your portfolio. And hopefully we can help investors do that.
Ryan Irvine's with me. You can find him at keystocks.com. Got a couple of webinars coming up, and for that you can just check out the details on mikesmoneytalks.ca right in the front there. Unfortunately, the webinars always have to be restricted in the number of people to get involved, but you have two choices. One is June 9th at 6 p.m. Pacific, 7 p.m. Mountain. June 16th, you can check in on 4 p.m. Pacific and 7 p.m. Eastern. Talking about a lot of subjects, but one of the things I know you're going to get to, Ryan, is something because you guys also do, we've been talking about more of the small caps. You also do with Aaron Dunn, sort of the quality dividend area of things. So I'm looking at this 10-year bond yield, whether it's 0.7, 0.6, whatever, and then I'm juxtaposing that with some pretty good quality, I think, dividend growth stocks, and some of them are yielding over 5%. So what's your perspective on that? I know you'll talk more about it in the webinar, but give me just a tease on that.
Sean, at the webinar is, there's a ton of money slushing around, unprecedented amounts, and it's having to find a place to settle. Like we talked about the 10-year U.S. government bond, 0.6%, 0.7%, in that range. It's not very attractive to most investors. And, Aaron just did a quick look at our dividend stock portfolio. The average yield on it now is above 5%. So you're talking about quality growth and dividend growth stocks that are relatively low payout ratios on most of them. It's a great way to place your capital with a long-term perspective. If you know those businesses, marry all the things I was talking about in the last segment with a great dividend payer that's not just going to be a stodgy dividend payer, but it's going to increase that dividend over time. It's a great place to be. And we just, in these seminars, we're just going to teach you how to simply, at the core, build a 15 to 20 stock portfolio over time that consists of, as a core, these type of quality dividend stock and growth stocks that we think should be core to your portfolio and are even more important in this type of environment going forward.
Okay, we don't have much time left here, so you know me. I'm always going to nail you and say, give me one or two things to put on my radar right now. Yeah,
and the first one is a company that we would consider on the higher end of the risk scale, but it's just because of where it operates geographically. It's Polaris Infrastructure, PIF on the TSX is its symbol. It's a renewable power producer. It operates in Latin America, currently Nicaragua and Peru. They have geothermal power facilities in Nicaragua and 3 run-of-river hydro assets in Peru. Now, why do we like the business? Because compared to its peers, it trades at a huge discount. Free cash flow, we estimate this year, about $2.30 Canadian. It trades at just in the $13 range. It's 6 times in that range free cash flow. It has limited debt levels. Its payout ratio, it pays a great dividend, it's about 6.5%. It's only 35% of expected free cash flow that it's paying out, so it has room to grow. It has contracted cash flow in Nicaragua, and that shouldn't be impacted in the current environment. In fact, we've seen a quarter post-COVID, and it was not, in fact, affected. There's good growth in the business. It's got a strong balance sheet, strong cash flow, and attractive valuations relative to cash flow. So, like I said, it trades in that $13 range. We have a fair value. We think it's actually worth $17.50 in that range. That is 30% higher than it is now, and it's a 6.5% dividend yield. So we call that growth at a reasonable price, and it's a business we like right now.
It's interesting, as you say, the geopolitical risk is one that's on the table right now. How hard do you look at that in terms of the stability of the political system, maybe the debt load of the government there?
Yeah, I mean, you have to look at all of those things, and that's why we consider the company to be higher risk. But then we factor that into our valuations. The company does get paid in U.S. dollars, so the currency risk we don't see as high because it's getting paid. It has contracted rates. It's producing power. The region needs power. So these are things that they do give it a higher risk profile, but you're being compensated for that. It's a 6 times free cash flow where its peers are probably trading at 20 times. So those are we know there is a higher risk, but we're getting a discount for that, and that's why we like the business.
We got 2 minutes for one more.
Okay, we recommended Enghouse at the World Outlook. This company, Sylogist, symbol SYZ on the TSX Venture, is kind of more of a mini Enghouse. There's $44 million in cash in the bank. They're a software company like Enghouse is. They service firms with accounting and fund software, grant management, and payroll. It's the public sector and nonprofits. It's a subscription-based model, SaaS-type model. It's about valuations for us on this business. It pays you a dividend of 4.3% right now. It trades at a significant discount to other software peers. It trades at about 11 times adjusted earnings. We think it should at least trade at 15 times. It's trading around $10.50, $10.40 in that range. We think it's worth $14.50. There's a ton of cash in the bank. They've doubled their dividend over the last 5 years, so they're responsible to their shareholders. And we think it's growth right now. They can make acquisitions in this environment. That's how they'll grow going forward. We think they will grow. It's growth at a reasonable price. And those are the type of businesses with fortress balance sheets that we want to own in this environment. And there's one example of one right there.
Well, a reminder that if you go to mikesmoneytalks.ca, you can get the details on the webinars June 9th and June 16th, the times, all of that kind of stuff, June 9th and June 16th. Take advantage of it. Take advantage of Pick Ryan Irvine's brain, Aaron Dunn's brain at KeyStone.com, Keystone Financials. Ryan, thanks again. Always love to get a chance to chat. Great job.
Thank you very much, and everybody stay safe out there. I would love to see you at our webinars. Have a good day.